As David has said, the last crash wasn't anticipated by what I've been calling a mainstream of economics for decades now, and I think people in the public are finally realising what I mean by that. That there's actually not just one approach to economics, there's several, but one particular school is dominant. And that particular school, really, I think you could call them, most of them shouldn't be given doctorates, they should be given Dr. Panglossians. They've got a very Panglossian view of how capitalism functions. And one of my favourites ever was Bernanke patting himself on the back, talking about the period that they saw as being signifying their success in managing the economy, that they called the Great Moderation. And this is a period where there were declining cycles in unemployment and inflation. So every time there was a downturn, the unemployment rate was lower, the inflation rate was also trending lower, and you see there he said that they saw the control of inflation, which was the obsession they have, that if you get inflation right, everything else follows. That's what they thought they were controlling, and this was a welcome change in the economy, writing in 2004 and speaking about the period after October 79, which was one of the many crashes beforehand. Now, that's a few years away from the crisis. My favourite statement just prior to the crisis about how wonderful things were going to be in the future, Dr. Pangloss again, came from the OECD. And this is both based on feedback from government bureaucrats who always think things are going to be wonderful. They've got to say that, of course, even if they don't believe so for their politicians, but it then goes into the econometric model that the OECD has now come their forecasts, and you couldn't say it better for getting it wrong. The current economic situation is in many ways better than we've experienced in years. Our central forecast remains quite benign. A soft landing in the United States, a strong and sustained recovery in Europe. Wouldn't like to see a downturn, would you? Strong job creation and falling unemployment. Now that was their vision, and what they were seeing and what they extrapolated forward were the cycles in unemployment and inflation I'm going to show you in this slide. We see inflation and unemployment, the red line being unemployment, the blue line being inflation, trending down until the crisis, which they see as a separate event. Suddenly unemployment goes through the roof, and for a short while, as you can see from the slight dotted red line you can see across the slide there, that's zero. So for a short while the inflation rate fell from about 5% to -2. Okay. Now it turned around afterwards when the rescue hit in on a grand scale, but you can see that trend there heading down and right below zero. So there was both a rapid increase in unemployment and a deflationary shock at the same time, which they simply did not see coming, had no explanation for. And in fact, after the crisis, they now talk about them as if there are two completely separate events. One they're responsible for, the other was an exogenous shock. Now, here's Bernanke, after the event, trying to excuse himself and the profession in general for not seeing the crisis coming. And he said, yes, OK, we didn't predict the crisis, nor did we incorporate the effects of financial instability, which is, that's a positive concession to actually say they left out something that after the event appeared to be important to them. I said, do these failures mean they're irrelevant, or at least significantly flawed? Now, I think the Australian cricket team could have done with Bernanke in the last series. We needed a good spinner. Okay, here's the spin. I think the answer is a qualified no. Economic models are useful in the context for which they are designed. Most of the time, serious financial instability is not an issue. That's an intriguing look at the last 40 years, isn't it? The standard models were designed for these non-crisis periods. Now that's intriguing, because I never saw a warning saying, do not take this in case of crisis. Okay. So, notably, they were part of the intellectual framework that helped deliver low inflation and stability in the 2 decades that began in the mid-1980s. I said, well, I'm sorry, as I said, that's just utter self-serving bollocks. Let's take another look at that data. This is the 1980 to 2010 inflation and unemployment. And what I'm going to do here is include rising debt. I better do that more slowly. The black line is the level of private debt, ratio of private debt to GDP. Now that is not the profile of a black swan. Okay? That is something you don't see the crisis coming if you ignore that factor. If you do include it, holy shit, Batman, something's going to happen. And that was the perspective that I come from, which is the non-orthodox, largely post-Keynesian school of economics. So that was what I was taking a look at, but they were ignoring. And I want to just indicate the impact of leaving that factor out, because when you graph inflation against unemployment at the time. So I'm just doing a graph here where the dark is the beginning of the time period and the red is the end of the time period. And you can see, I'll just illustrate it in a moment for you, this is the blowout in unemployment and inflation that they call the stagflationary period. And that phenomenon is what Milton Friedman used gleefully to help undermine what they called Keynesian economics beforehand. It was actually came from Paul Samuelson far more than Keynes. But that was seen as invalidating the Keynesian period, and that's why they had to bring in the monetarist controls, etc. This is the days of Tina. You all know Tina? You know, Maggie Thatcher's best friend. Okay. And then, of course, this is their period where you have a declining unemployment and declining inflation, and it's all heading towards this lovely point called equilibrium until what the shit was that? Okay. Now, notice over here you've got a very similar object. That is their actual data for America, smooth, so you don't see all the real day-to-day fluctuations. It's the smooth data from 1980 to 2010. Let's just tilt it up a bit, because I'm actually showing you two dimensions of a three-dimensional object. The dimension I've left out, as I'm displaying it here, is the ratio of private debt to GDP, which neoclassical economists will still assure you is irrelevant to the economy. Let's tilt that up.
What is private debt?
It's bank lending by banks to households and firms. Now, that alone wouldn't make me allege there's some sort of pattern on there, because the rising level of private debt seems to be what causes the system to tip over from what looks like stability into instability. But to really verify that it's a pattern, this is a mathematical model I built in 1992. With one addition, I've included prices, which I didn't include in the 92 model. Exactly the same qualitative dynamics. Notice how the cycles there, now we're now looking at the cycles in inflation and unemployment, they're getting smaller, just as they're doing over here, though of course in the real world things are rather messier, but the same basic pattern. Smaller and smaller volatility. The area of these later years before the crisis hits covers that little square there. The areas earlier cover the whole large area of larger unemployment, larger inflation. Same sort of story here, and then suddenly, bang, out to a breakdown. So what this model is generating is a period of diminishing cycles in inflation and unemployment, followed by a breakdown. In other words, this model generates both phenomena in one. And I'm arguing that the Great Moderation and the Great Recession, as the neoclassicals first called it, were the same phenomenon. So what looks like heading towards equilibrium and sudden collapse in the real world happens exactly the same way when you model what's called Minsky's financial instability hypothesis, which has been the basis of my positive academic contribution for the last 20, 30 years. And it's including what's called complex systems dynamics in there as well. Now, why does the mainstream ignore that third dimension? Okay. Well, the logic is that debt is like a consenting act between adults. Doesn't affect anybody else. You can do whatever you like in your own home, or somebody else's, if they let you in. So they ignore it. They see no social impact from the level of private debt. And you might know the name Irving Fisher. Okay. Probably for the negative reason that he made this famous statement right in the middle of the Wall Street crash, that stocks have reached what appears to be a permanently high plateau. Yeah, the ultimate bad prediction in finance. But after the event, he went back and, unlike the modern-day neoclassicals, he realised that to be so completely wrong about the economy, there had to be something wrong with his model. And he went and developed what's called the debt-deflation theory of Great Depressions, and Hyman Minsky really based his work more on Irving Fisher than on Keynes. The original concepts came from Fisher. So Fisher talked about what he called debt deflation, and this is Ben Bernanke's book of essays called Essays on the Great Depression, where he was regarded as the expert on what caused the Great Depression. Now, you'd think that if you were the expert, you'd consult what everybody else wrote and pay attention to it, and then make a considered judgment of what was the overall perspective. Well, here's his statement on Irving Fisher. He says, Fisher's idea was less influential in academic circles because of more influential with politicians, in other words. Roosevelt took it seriously, and that affected the policy that led to the New Deal and a range of other policies in the 1930s. He said Fisher's idea was less influential in academic circles because of the counter-argument that debt deflation, and take a good look at this sentence, represents no more than a redistribution from one group, debtors, to another group, creditors. Now, to begin with, I hope you're seeing the turkey there. Because when somebody goes bankrupt, they don't pay their debts back. Okay? Even on that level, it's a naive statement of what happens when people go bankrupt. But he then says, following on from that proposition, an a priori, and again, this is where, when economists use the word a priori, Latin for before the event, it's a set of notions you design before you look at the data, and once you've got those notions, you ignore the data. That's what's going on here. Absent implausibly large differences in marginal spending propensities among the groups, i.e. between debtors and creditors, pure redistributions should have no macroeconomic effects. In other words, what they're seeing in debt is not a creation of anything new. It's a redistribution of existing money from one group to another. And unless there's some dramatic difference between the groups, there should be no macroeconomic impact. Now, I would hope that after the financial crisis, that wisdom had gone out the window, but no, it's still there with the fairies. And the basis of it is this model that Paul Krugman in particular promotes, called the model of loanable funds, which is the way they envisage what banks do, and therefore why they ignore banks in their thinking. And writing in his book, End This Depression Now, ! He said, think of it this way. When debt is rising, it's not the economy as a whole borrowing more money. In other words, he's saying there's no link between the level of debt and the level of money. So it is rather a case of less patient people whom for whatever reason want to spend sooner rather than later, borrowing from more patient people. Now, one thing I find funny about neoclassical economics, mainstream economics, is the extent to which they'll call themselves a value-free science. All three words, I think, are wrong. And then make value-laden statements throughout. Who's the good person, the patient or the impatient? Okay. Now, they're completely wrong, and I've got to say one thing I'm very pleased about being in London these days is that probably the most open-minded bank in the central bank of the world is the Bank of England. So I find myself having plenty of conversation with Bank of England staff. They listen to views from the outside the mainstream, so they're very, very good. And out of the blue, I had no warning this paper was turning up. They published a fantastic paper that I've linked there in their quarterly bulletin in 2014, saying that the vulnerable funds model of banking is simply structurally wrong. It's not how banks operate. They say banks are not intermediaries. They initiate loans, and when they do, that loan creates new money. And what they don't elaborate on, which I'm talking about here, is that also creates new demand. And the logic is quite simple. The model the mainstream has, this loanable funds model, says that the lender offsets the borrower's higher spending power, because if you lend money in what we might call a person-to-person loan, if you lend somebody the taxi fare to get home, you've got to get the tube. Okay? You can't afford. If you give the money away, you can't spend it. Therefore, the increased spending power of the lender is offset by the borrower is offset by the smaller lender spending power of the lender. So I can actually model that and take a look at expenditure, and imagine you have a patient person, an impatient person, and a shop. And the impatient person wants to borrow money from the patient person, so they borrow the amount of money B, so they can now spend money both on the patient person, buying something from the patient person, and also buying from the shop, but they can now spend more money to do it. Now, what I'm doing on the diagonal of that table is showing expenditure. So the money comes out of the impatient person's account, big A plus big B plus little b, and then it gets spent on patient, which is big A, and the shop, B plus little b. But having done that, the patient person has now got B less to spend on both the impatient person and the shop. So if you look at the total demand, you add up the negative sum of that diagonal will give you aggregate demand. The sum of the off-diagonal elements is aggregate expenditure. There's the loan. The impatient, therefore, spends more money. The patient person spends less, and one cancels the other out. That's the model they have. Now, the real world, and believe me, there's a big difference between what economists model and where we live. The real world is that the impatient person borrows from a bank, and the bank gets an increase in their asset, which I'm not showing here, but in the bank accounts, which is where the money goes, the impatient has more spending power. There's no decline in the spending power of the patient agent. So the money created by the bank by the loan becomes additional spending power as well. You borrow money to spend it on something else. You don't borrow money to have it sitting in your account accumulating an interest bill for yourself. Okay. So what you therefore get out of that is the perspective that demand and income, because they're, in the classic sense, your spending becomes somebody else's income, so the two are identical. Demand and income come from the turnover of money you've already got, existing money, plus demand and income from new debt. And that's why the change in debt is so important. It's a major provider of additional demand, and that rising debt increases demand and income and also asset prices, because a large part of that money now, and frankly about all the banks will ever lend to you now for, is speculating on shares or houses. They won't lend for anything stupid like a business. But equally, when debt is falling, that reduces demand and will also reduce asset prices. So what you have is a relationship with the change in debt and the level of demand and also level of asset prices. And when you take, I'm going to be slightly mathematical here, take the rate of change of that, the differential, you get a relationship between acceleration in debt and change in asset prices and change in demand. Now, as you know, acceleration is much wilder than velocity. Okay? So that change in demand and the acceleration is more volatile again, and that's where a large part of the volatility in our economy comes from. So you can use both the change and the acceleration of debt to explain the boom before the crash, which was what they call the Great Moderation, the crash itself, because at that point in time change in debt went from positive to negative and went from positive acceleration to massively negative acceleration to achieve that, and the ups and downs of asset markets as well. And unfortunately, my term that I first coined, I know what the Vapors song is about. I think it's extremely apt for those who know what the lyrics of Turning Japanese are about. But we were turning Japanese, and I said that about in 2000, back in the first edition of Debunking Economics. And the reason we're turning Japanese is Japan did this first. Japan went into the biggest private debt bubble in the history of capitalism before the Netherlands caught up with them, as it happens, back in the 1980s, and it crashed in 1990. So if you look at what the Japanese did, what I'm showing now is private debt to GDP across a whole range of countries. But notice the first one there is the Japanese bubble. And their level of private debt went from 140% of GDP, which is already high, as you can see, compared to the rest of the world, up to 225% in the peak after their crisis. The crisis always occurs before you reach the peak in private debt, and then they've been in this long, slow decline ever since. Meanwhile, America, and this is in the UK as well, this is the UK data here, began its bubble shortly after the Big Bang. The liberalisation of the banks led to a small crash back in 1990, and after a recovery from that crash, then England, where's America, Australia, etc., all got caught in a private debt bubble. So if we were in empirical science, which we're not, we're neither empirical nor a science, we would have spotted all that and done something about it. Instead, we all fell into the same trap. And China, we'll talk a bit about in the talk here, China's entered the trap after our global financial crisis. It's now doing the same thing, only, as usual for China, far faster than anybody else. Now, what this next chart shows you is the sort of thing which, if economics was an empirical discipline, there'd be millions of people out there exploring it. I've been talking about this for 10 years now. I've been showing graphs of this relationship for a decade. I still have yet to see anybody attempt an econometric paper, apart from people who actually work with me, on this data. But this is showing the relationship between the change in private debt in Japan as a percentage of GDP and the unemployment rate. And if those of you know correlations, can you spot it? The correlation coefficient between the change in debt and the level of unemployment in Japan is minus 0.91. Since 1965, we're talking over half a century. That's phenomenal to get a correlation like that. You'd think you'd be taking a look at the evidence, but again, that a priori notion that I mentioned earlier comes into play. And because a priori, it's a pure distribution, they don't even do the testing of this data. It's finally turning up, I might say in some papers, people like Morris Schulrich certainly have been making a strong case about it, Claudio Borio, but these are people who are slightly outside the mainstream. The mainstream is still ignoring this information. Now, looking at the United States, this is the correlation for the same data for the United States, unemployment and change in debt since 1990. That's so close to a perfect correlation, it looks like a Rorschach plot. For those who remember their old psychology, that's minus 0.93 since 1990. I often get people saying correlation isn't causation. When you get correlations that high, it's about time you look for a causal explanation, which of course I've done. Now, given what Japan has been through, I think Japan gives us unfortunately, the best case scenario for what we can expect going forward in the modern world, because they did the same stupid thing we did 18 years before we did it. They haven't addressed the causes. They're still obsessing about government debt, though they've let it get to 2.5 times GDP. But they think that's the only thing they need to do. They've ignored the level of private debt. So what I've done in this chart is I've taken that same bunch of graphs I showed you earlier, different countries' private debt to GDP ratios, and I've now moved Japan 18 years so its crisis coincides with ours, and therefore, at a heuristic level, what it goes through is what we can expect to go through if we don't have a different set of policies. And you could see that it reached a peak of private debt of 225% of GDP. It then slowly delevered over the next 15 years, and for the next 10 years, it's been bouncing around at much the same level of private debt. So for that whole 25-year period, credit, which is normally a major driver of demand, has been absent and actually negative as a driver of demand in Japan. Now, they could get away with that to some extent because they could export to the Ponzi scheme that the rest of the world was caught up in. Unfortunately, so far as we're aware, there is no Ponzi scheme on Mars. So we can't collectively export to Mars, which we'd need to do to be in as good a situation as the Japanese have been. Now, not only are we in a bubble of historic proportions in the post-war period, it's also, when you look at the data and normalise it over time, it's the biggest bubble in the history of capitalism. This is taking American data, and I had to patch together 3 time series to make up the data before 1950, which you can see all the data from here on is data recorded by the Federal Reserve, and you can see the ratio of private debt was rising all the way through with a couple of big humps until this final downturn here. The data for the 1930s was by the Census Department, and when they look at the data without trying to fit the 2 data series together, it's up here somewhere, above that level. But applying the overlaps and saying, well, let's use the Federal Reserve's definition and go backwards, that's the pattern I get going back to 1834. So if we'd use the same definition the Federal Reserve uses now, that's the pattern we'd find in the data. And clearly, on that basis, the highest level we've ever had. In fact, we're trying to recover now from a level of private debt which, using this renormalisation, is higher than the peak during the Great Depression, which I think basic expression there is good luck. Try doing it. Now, non-orthodox economists saw this coming, as David said. Only the mainstream didn't see it coming. The first person who really warned of it was one of your own, Wynne Godley. Wynne died about 2 years ago, I think, or 5 years ago, pardon me, about 2010. But he began warning of the inevitability of a crisis using what modern monetary theory calls stock flow consistent accounting back in 1998. I began warning of it in 2006. And we were both, with different perspectives, focusing on the same thing, that the trend in private debt was unsustainable. It had to turn around, and when that trend did turn around, it would cause a crisis in the economy. Now, the mainstream ignored us because, as far as they're concerned, the trend we were looking at didn't matter. Well, good luck for that. Now, that's showing you the relationship so far in the real economy. They also apply in the asset markets. And what I'm now looking at is the relationship between the acceleration of debt, so the rate of change of mortgage debt, and I'm normalising that against GDP. So I've got the rate of change of debt divided by GDP, and I'm plotting that against change in house prices. And here I'm looking just at mortgage debt in America. So all those geniuses who made a fortune out of the housing market, they were riding a debt bubble without being aware of it. The correlation there over, again, 25 years is 0.77. I must admit to a bit of cowardice here. I didn't test this empirically because I simply, even though I knew that the logical step was that since change in debt was related to the level of asset prices, acceleration should be related to the rate of change, but I simply didn't think the data would support it. Then an English economist called Mike Begg came out with a paper where he did the econometrics and talked about the Phoenix effect and got it right. So I didn't do this first, but once I saw Mike did it, I thought, stupid me for being a coward, dive in and check the data, and those are the correlations I could find in the housing market. A similar thing applies in the stock market when you look at the relationship between acceleration in margin debt and change in stock prices. This is the S&P 500 versus margin debt, acceleration over time. Correlation there is 0.53. And again, because you're working with the rate of change of a rate of change against another rate of change, the fact that you get a correlation at all, given how messy economic data is, to me still I find remarkable. But you can see the depth of the downturn, both back in 2000, when the Nasdaq bubble blew, and the one in 2008, when the market totally blew. And it even applies in China. I've just put this data together in the last couple of days, so it's the first time I've actually shown this in public. This is the Shanghai, the red line is the Shanghai index, and people are talking about the Shanghai index crashing now. They don't seem to be aware that it also crashed back in 2007. But when it crashed back in 2007, there was no such thing as margin debt in China. You know, of course, once China makes something, it makes something very quickly. So they went from, I'm not joking, the level here when the data first turns up, the level of margin debt compared to GDP is 0.000014% of GDP. It's a couple of yuan, a couple of 100 million yuan, but trivial. They rapidly rose to having 2% of GDP in margin debt, and most of that rise has been in the last year. I wonder why the stock market boomed and crashed. Looking at the same relationship I mentioned beforehand, the acceleration of margin debt against the change in the index. And again, this won't matter when margin debt is trivial. Okay? It only comes into play when margin debt becomes substantial, which is in this case, over 0.5% of GDP. So the red line is the change in the index, the blue line is the acceleration of margin debt. And what the Chinese Politburo is trying to do right now is stop the deceleration of margin debt. Well, good luck to that. Okay? It's just not the sort of thing one can control. The correlation there, 0.69 since 2014 and 0.87 since 2015. So this is what's driving the downturn in the market, and it's an irresistible force, given the scale of money we're talking about there versus the relatively trivial sums that the Communist Party is trying to throw to keep the market up. So that's the instability we're dealing with, and the mainstream completely ignores instability. In fact, they see capitalism as a system that heads towards equilibrium. Now, instability is not necessarily a bad thing. There are some very creative things about instability. For example, anybody who walks out of this room is being unstable. Okay? Sony engineers found some years ago they tried to design a robot that walked. I think it's called Ebo or something like that. And what they did was they thought, well, the most important thing is to maintain the centre of gravity as it walks. And they found the thing could stumble ahead, couldn't move. So they finally realised they had to let it fall. And as you fall and take a step, you're unstable until you land on one foot and land on the other. So walking is actually a disequilibrium process. If you want to maintain equilibrium, it'll be about 2 days before you walk out the door. So let's talk about the undesirable instability now, which Minsky focused upon. And he said capitalism is inherently flawed, being prone to booms, crises and depressions. He said this instability is viewed as characteristics financial system must possess if it is to be consistent with full-blown capitalism. In other words, he's saying it's not the sort of thing you can reform out of existence. It's something that fundamentally has to be there. And he said basically such a system will be capable of generating signals that induce an accelerated desire to invest, so rising profit brings that inducement to invest more, and of financing that investment, so you borrow the money to finance the investment when the level of investment you wish to undertake exceeds your retained earnings. And he called the model the financial instability hypothesis, and cycles, debt and non-equilibrium behaviour at the complete centre of his thinking. Again, very much unlike the neoclassical world, where all three don't exist. Okay? Cycles, exogenous shocks; debt, irrelevant; and non-equilibrium, economy is always in equilibrium or near to it. So Minsky, on the other hand, started from a very, very different point and said the natural starting point for analysing the relation between debt and income, now according to the mainstream there is no relationship, is to take an economy with a cyclical past, and according to the mainstream there's no such economy, that is now doing well. He said the inherited debt structure of the economy reflects the history which includes a period in the not too distant past where it did not do well. So we go back here to, say, the 1990s, which is the last major recession before the boom of the telecom boom, then the dot-com boom, and then the subprime boom. And he said accepted liability structures at that time are based on some margin of safety, which you want after a crash has occurred. So you've got enough money when you borrow money, you've got enough of a buffer left over to cover things when things go wrong, because you now expect them to go wrong after the crisis. But as the period over which the economy does well lengthens, two things become evident in boardrooms. Notice he's talking about boardrooms there. He's not talking about the mythical world of perfect competition, which is the neoclassical fantasy to describe the economy. He's talking about Wall Street, large corporations, firms that borrow money, plan investment on a large scale, and so on. He said they realise that existing debts are easily validated, so it was easy to repay the debt, more easy than they thought it would be, and units that were heavily in debt prospered. It paid to lever. So this changes expectations. People think the margin of safety they had was too high, so they're willing to accept a larger level of leverage and to take on more speculative investments. He said, as a result of this, the amount of debt used to finance various types of activities increases. That, therefore, increases the weight of debt in financing the market price of capital assets. So we saw a direct link between the level of debt and the price of capital assets, again, which the mainstream argues doesn't happen. And it increases investment and transforms the economy from one that's just stable after a crisis into a boom economy. So you get a period of speculative excess coming out of that. And he said, therefore, stable growth is inconsistent with the way in which we determine investment in our economy. So therefore, and this is what, when I read this, I thought this is one of the deepest insights I've ever seen, because I've read so many critiques of capitalism and so many pay-ins to it as well. But this was the first time I saw a critique which I thought was well-founded. A lot of Marxian critics will say, oh, capitalism will tend towards stagnation. That wasn't what I was seeing around me. I was seeing euphoric behaviour. And what Minsky said was the fundamental instability of a capitalist economy is upward. The tendency to transform doing well into a speculative investment boom is the basic instability in a capitalist economy. And then, of course, what causes the downturn is you borrow money for ventures that fail, and you then have an overhang of bad debt which crashes the economy later. So it's a non-equilibrium process, and spelling it out step by step, it goes something like this. Again, you go back in historical time. Now, history and time are two things which conventional economics has attempted to abolish, which is pretty hard to do, but they've certainly ignored it in economics classes, so I'm bringing them both back in at Kingston. But historical time. So you look back, you know there's been if you're looking at 1992 and 93, you had a crisis back in 1990. That debt-induced recession in the recent past means that both firms and banks are conservative about the amount of debt they'll take on. And this is not what economists, neoclassicals, even good guys like Joe Stiglitz, call asymmetric information, as though one has information about the future. I'm using a quote from the editor of a major journal there, by the way, information about the future. They both share the same expectations about an uncertain future. So they're both conservative. Both borrowers and lenders are conservative about the amount of debt they'll take on. Therefore, you only fund conservative projects, but because the economy has recovered from the crisis, most of those projects succeed. That therefore means that both firms and banks think, oh, we were too conservative last time round. They accept a high level of risk the next time round, higher debt to equity ratio, a higher valuation on assets, and you get self-fulfilling expectations that mean there's a decline. With the decline in the reversion to risk which has gone on, you have an increase in investment, and that investment helps the economy expand faster. So partly there's a virtuous circle there. But you also get rising asset prices, which means any fool can make money on a rising market. And they therefore think they're geniuses. You get an increased willingness to lend, and as I've shown in the verbal argument earlier about patient versus impatient, all that nonsense, the increased willingness to lend increases the money supply, and that also increases the demand on which these expectations are based. So you get a growth in the economy coming out of this, riskier investments being enabled, of course, more of which are going to fail, so you're accumulating more bad debts as you go forward, rising asset speculation, and you get what he finally called the euphoric economy. If anybody wants to do a combined literary and statistical PhD one of these days, doing an analysis of the word euphoric to describe expectations in the Financial Times over history would be quite an intriguing study. Long before they read Minsky, they were talking about how the state of mind in the city was euphoric. Now, this allows what Minsky calls Ponzi financiers to turn up. And they're capitalists, well, it's actually an insult to capitalists to call them capitalists, but still, who have a cash flow from their investments less than their debt servicing costs. In other words, they're fundamentally insolvent. How do they survive? They sell assets on a rising market, and they're desperately trying to maintain a cash flow by borrowing more money. As their cash declines, until they can sell an asset. So they've got a desperate demand for debt because they're fundamentally insolvent. They've got to borrow to service existing debt before they can make those asset sales. So they have a totally interest rate insensitive demand for finance, which is why you can't stop this stuff by putting up rates. My favourite Ponzi is a guy called Christopher Skase, who none of you thankfully know. And he was an Australian Ponzi speculator who got his money from a firm called, what's it called? I've forgotten the firm's name now, but Larry Adler was the boss of it and his son Rodney. And Larry and Rodney used to play a game of swapping roles of meeting Chris when he came asking for another loan. And the game was put the rate up by 1% and see if he says no. And he never did. They got to charging him 25% and he still said yes. The reason being, if he didn't get the money, he was bankrupt the next day, most of the time. Now, initially, you have asset speculation like this is profitable, but that also reduces people's sensitivity to debt and interest rates. It drives up the supply and demand for finance. It can push up market rates as well. But you also get a change in income distribution going on in the background. Because the economy is booming, wages can rise, as they did in the early 2000 boom. And the cost of raw materials will also rise. You pay for those on an open market. There is a supply and demand constraint for them. Their prices will rise, which changes your profit outcomes. Now, eventually, that rate of growth of debt will break for some internal reason. You don't need an external trigger like a central bank putting up rates. Normally, they provide the trigger anyway. Okay, so you get two reasons for it, but it's all internal dynamics. The changing cost structure, which the boom itself has caused, will undermine the profit expectations that led to the boom. The Ponzi's are necessarily losing money. All it takes is them to miss one repayment and they're bankrupt. And that's often what happens. The reason Skase is one of my favourite Ponzi's is that he made a takeover bid of $3 billion for MGM. A guy called Krikorian. Does anybody know the name Krikorian? The leading venture capitalist and capitalist raider as well. He was on the board of MGM, didn't trust Skase, investigated his finances, concluded he was insolvent, told MGM board don't sell to Skase. They didn't sell to Skase. 1 week after they decided not to sell to him, Skase went bankrupt. Remember he made a $3 billion takeover bid? He couldn't pay a $12 million loan instalment the next week. That's why he folded. And that's why they're the early canaries in the coal mine, because they can crash instantly if they can't roll over those debts. So they're the fragile ones. I know the bloke with the weird hairdo in America might go that way one of these days, but I've been waiting for that to happen for a long time and it hasn't, so maybe I better not get my hopes up until after he becomes president. Now, many of those euphoric investments also fail too. My favourite example of euphoric investment would be somebody in, I don't know what part of London it would be, but somewhere where Rastafarians are popular, who thinks Rastafarian hairdo is going to take off and borrows a large amount of money to buy horse shit, which is how you make Rastafarian hairdos. They fold. They have euphoric expectations that aren't going to work. At the other end of the spectrum, people who are raising horses for genuine reasons, they take out conservative positions and then find the interest rates have risen and they can no longer service their debts. What do? They sell assets into what they think is a broad market. But when they do it, the market is very narrow. It can crash with the flood of new stock being put into sale. So you get the trend in rising asset prices turns around, and when that does, the Ponzi's are the first ones to fold because they can't sell assets for profit anymore and they're already bankrupt. And nobody's going to roll the debt over them anymore. They're going to fold. That's why your most prominent business people, often being Ponzi's in nature, are the first ones to fold when a crisis hits. Asset prices collapse, debt-to-equity ratios rise in the process, the expansion of the money supply goes into reverse, investment evaporates, you're back where you started. Now that's pretty much a description of 1993 to 2007. Okay. But we've had several cycles like that beforehand. What's special about 2007 is the situation that applied after the crisis occurred, which had been built up over a number of cycles like this. So the inflation rate at the time can be a major determinant of what happens next, and also the size of the government sector. If you have high inflation, which is what applied back in the 80s, there's huge wage pushes and, of course, the OPEC price rises at that time. People blame OPEC for the 1970s and 80s crises. I think that if it hadn't been for OPEC, we would have had a deflationary crisis, possibly back there. They put up the price of oil so much, and wages were rising so much, that the rising price level let people who got into debt problems pay their debts back. as the cash flow just rose because of inflation. But you get low economic growth because investment's not taking place, and that's what you would call a Keynesian explanation for stagflation, which Minsky first wrote back in, I think, 1982. And the cycle will start again after debt levels fall once more. With low inflation, that's the situation we're in now, debts can't be repaid out of the cash flow. And you get a chain of bankruptcies that affect even businesses that weren't speculative, and you get a depression. Now, the reason to avoid a depression is big government, because the spending that they do is anti-cyclical. The taxation revenue depends upon employment and profits. The spending depends upon unemployment. When the economy goes down, government spending necessarily rises. And that automatic stabiliser, as known in the normal literature, I see as a way of providing cash flow for companies they wouldn't otherwise have. And with that cash flow, they can remain solvent. And that's the major role the government deficit plays. But you'll get a cycle again after you reduce debt levels once more. So what I've been doing is building up mathematical models of Minsky, and I know that looks a bit on the complicated side. I'll take you through it in a moment. But that is a model which, as I said, I developed in 1992. I've added in prices recently to make the dynamics more realistic. And I know that looks like a complicated mess. So, of course, like a typical academic, I'm going to show you more of it. Because actually, however, what I'd call simple but complex, and this is an important distinction. People think that to get a model which has complicated dynamics, you need to have complicated internal structure. But the whole idea of what's called complex systems says that complex behaviour emanates from simple rules. And I'm going to show you just how simple the rules are behind this model, because as complicated as the diagrams are, it actually boils down to three literally irrefutable statements. In other words, if you disagree with these, why don't you hop out of the shard too and disagree with gravity? It's about as sensible. The first statement is the employment rate will rise if economic growth exceeds the sum of population growth in growth and labour productivity. Okay, so the economy grows faster than population growth occurs and people become productive, the employment rate will rise. That's just a dynamic way of stating an empirical fact. The second one is wages share of output will rise if money wage demands exceed the sum of inflation and growth in labour productivity. Now, one of the reasons wages have been falling over time is we've been getting compensation for inflation but not for labour productivity. If we'd got wages that have been increased because of productivity as well as inflation, the worker share of output wouldn't have dropped as much as it has in the last 20 or 30 years. But that's another empirical fact. But the third fact is actually simpler. It'll look more complicated when you first take a look at it. And that's saying the ratio of private debt to GDP will grow if the rate of growth of debt exceeds the sum of inflation plus the rate of economic growth. That's also a straight-out fact. It's just two ratios and splitting them apart. So those are three irrefutable statements. You can argue that I've left out other ones that matter, and I have left out the role of the government here because I want to illustrate just a pure capitalist economy right now. And you can also argue that I've left out important determinants of each of those variables when I put a model together. But I want to show you just with those statements the sort of behaviour that emanates from it. And it's not something you can work out using verbal logic alone. This is one reason I'm a fan of proper mathematical modelling in economics, not the garbage that neoclassicals do where they presume equilibrium and go from there and work with difference equations rather than differential equations and all sorts of simplistic things like that they think are complicated. But because you can't deduce this sort of system just by verbal logic alone. And I'll explain the model in a moment, when you model those three variables together, you get two possible outcomes when you don't have a government sector and you don't have bankruptcy. One is what can be called a good equilibrium, where the system converges over time to this equilibrium, where there's a finite ratio of private debt to GDP, a positive employment rate, and workers have a constant share of output. That's the good equilibrium. The bad equilibrium is an infinite debt ratio. Remember, I've got no bankruptcy here and no government to counteract what happens in the private sector. So this is an Austrian dream, which I'm proving is an Austrian nightmare. Okay? Get rid of the government and enforce all contracts and you'll end up in the black hole of debt. So you get infinite debt, zero employment and zero workers' share. And I'll now bring up that model and simulate it here. This is a software package I call Minsky, by the way, for obvious reasons. And it's open source and you can download it from SourceForge quite freely. And what I've got, I'll show you quickly, setting up the system that I built the model on, a cyclical model by an American economist called Richard Goodwin. which was actually based on the model in Marx's Capital, the verbal model in chapter 25 of volume 1 of Capital. And that was just had a cycle between wages and employment, the first two equations effectively. And when you put those equations together, rather than getting equilibrium, you get a system which cycles. Employment and wages share both cycle. If I plot one against the other, I get a closed curve. Now, what I added to that model was debt. And I therefore had capitalists, when their desire to invest exceeded retained earnings, they'd borrow money from the bank to do it. And I'm modelling this with a simply linear set of equations. So a lot of economists, including unorthodox ones, make a song and dance about behaviour and how important it is to model behaviour carefully. This has got the simplest possible model of behaviour. I've got a linear relationship between the level of employment and the wage demands workers make. Just a straight line. Okay? And equally for capitalists, I've got a linear relationship between the rate of profit and the amount of investment they want to do. Now, you'd think something that simple couldn't possibly model anything like you see in the real economy. But what struck me about this model when I first built it back in 1992 is the behaviour you're about to see. Remember again that neoclassicals talk about the great moderation, for which they took credit, where cycles were diminishing, and then the crisis, which is somebody else's fault. Okay? They both happen in this model. If you watch the cycles that are going to happen in employment and wages share of output, you'll see the cycles are getting smaller. I'll speed it up a bit there. So the cycles for a while are diminishing. The employment cycles are clearly getting smaller. Wages cycles is getting smaller. The wage ratio, the wages share of output is also, as you can see, trending down. But that doesn't matter because who gives a stuff about workers anyway? Okay? That's my profession. Okay? I'm channeling. Okay? And notice the debt ratio here is declining. So that's in a situation where I've set up the level of profit, the aggressiveness of capitalists to be quite passive. So I'm showing you the good equilibrium here. And what they saw, what the neoclassicals saw, was that's what they thought was happening. They didn't at all factor debt into their thinking. What's happening over here, though, the debt ratio is heading towards a stable level. It's stabilising at about 30% of GDP. Now, what I'm going to now do is change it so I look at a more aggressive capitalists who are more likely to borrow to invest. And notice the change in the structure. I'll slow that down if it's going too quickly. The cycles are getting smaller, so the great moderation appears to be happening. But then, without warning, the cycles start to expand. Notice that the loop here is getting larger. And notice the debt ratio is now well above 200% of GDP. Notice wages are declining quite seriously here, not stabilising. And ultimately, you get a complete breakdown. Now, I won't go all the way to the breakdown there because it's unrealistic to have linear relationships. Because when I say there's a straight line relationship between the rate of profit and the level of investment, I'm arguing that at a certain level of investment, capitalists go around smashing up factories. No, they don't. Okay. So the non-linearity just says, no, when the profit rate falls towards zero, their investment also falls towards zero. But when it gets high, they become euphoric and invest more money. So if I bring in a non-linear relationships here, and I include prices in the dynamics as well, then I get something that looks much more like the crisis we actually had, because all the volatility is on the downside. So the model, again, when you look at it, appears to be cycling in towards equilibrium. Pardon me stopping and pausing, although I might make it a lot slower and just give it time to happen dynamically while I talk. But if you're looking at the cycles in employment, they're getting smaller. And now looking at inflation as well, because prices are here, that's also trending down. You appear to be reaching this wonderful period of equilibrium, but you're ignoring the ratio of private debt to GDP, and the red line here is private debt, which is getting higher and higher. You can see it getting higher over here as well. And then as the simulation goes on, notice the profit share reaches what looks like a nice equilibrium. Okay? So from a capitalist point of view, nothing could be better. Workers are getting less, but again, the usual story, who cares about them? Inflation is now turning into deflation. Employment starts to collapse. And at some time in the future, this is taking about 25 years to happen, suddenly the profit rate collapses as well. And if I let it go on indefinitely, profit turns negative, and you end up in a complete black hole. Now what's going on is, in a verbal sense, the declining workers' share is being offset by rising bankers' share until such time as deflation starts to increase the rate of compounding of debt. And at that point, the workers can't cut their wages fast enough to make up for the increasing bankers' share. More money goes to bankers rather than capitalists, profit and investment collapses, and the economy collapses in toto as well. And that's what I think we've been through. So these are the various models shown again here on the slides. So rather than those two phenomena, the Great Moderation and the Great Recession, and inequality, rising inequality, which even the mainstream now concedes is happening, rather than being separate phenomena, they all emerge from an extremely simple behavioural structural model. And this is why people from my side of economics emphasise on getting the structure right, being realistic about the nature of capitalism. Get that realism right, and the structure itself will tell you 95% of what you need to know. Adding the behavioural stuff on the edges is frippery rather than the focus of how modelling should be done. So you get a decline in volatility in employment and inflation before the crisis. You get rising inequality because even though in this model firms are the only ones borrowing money, socially the group that pay for it are workers. Workers' wages drop, debt level rises, profit remains much the same until the crisis occurs. So workers pay for the higher level of debt. And you get a crisis when that rising debt service exceeds the declining wage payments. Now, I first built that model in 1992, August 1992 as it happens. So I simulated before the events that happened, that are now part of folklore, actually occurred. And both the model and the historical record imply that debt crises are endemic to capitalism. Okay? You can only avoid the crisis if somehow you can reduce the level of private debt. That's the essential thing to do. Now, the banking system already has a way of doing that. For corporations, of course, bankruptcy, if a firm can't pay its debts, it goes bankrupt. And there's no way you can make a corporation pay its debt after it's gone bankrupt. It no longer exists. But for households, of course, they're trying to make sure we pay our debts. Okay? Even if you go bankrupt as a household, you're still alive after the experience. So people are now trying to enforce that debtors must pay their debts as if that's essential to capitalism. In my opinion, it's essential to capitalism failing. We have to get to the stage where debtors' rights are greater than creditors' rights, because if you enforce creditors' rights, you end up in a black hole. So the trouble is you can't rely upon this mechanism alone, because using this, what's really an episodic approach for bankruptcy, where you make loss provisions for a fraction of your loans to go bad, doesn't work when the whole system goes bad. It'll actually amplify the downturn initially. So we need a systemic remedy for these systemic tendencies towards excessive debt and crises. And in the opposition to what's known as Ordo-liberalism, which is can anybody guess who's the main proponent of Ordo-liberalism these days? Okay, Schauble. Okay, this is the guy who's enforcing the debt turns on Greece. Okay, there's a particular form of Austrian economics called Ordo-liberalism, where ordo means order. And the major part of this is you must enforce contracts, you must pay your debts. Well, that for me is a recipe for the collapse of capitalism. So we need a policy which emphasises the need to write debt off. And something that stops us doing that is we have a pro-creditor philosophy which partially comes out of the fact that all of us confuse the lending we might do between each other with bank lending. Now, if I borrow money from one of you in the audience and I don't repay you, I've effectively robbed you. Okay, you had to work to earn the money that you're giving to me. You can't spend it when you're giving it to me. If I don't return it to you, I've taken money out of your pocket that you worked to earn. And therefore we think you should repay your debts. It's part of our natural thinking about interpersonal relationships. Because the person-to-person lending, the lender has to save before doing the lending. And therefore the non-repayment is akin to theft. But what banks do is create money by double-entry bookkeeping. And this is what the Bank of England emphasised in their paper as well. Debt and money, the money that's being lent, are both created at the same time at minimal cost. I have a wonderful anecdote about that coming out of a service station owner in New Zealand who applied for a overdraft to run his service station or petrol station to the Westpac Bank, which is a leading Australian bank. And they approved his application for a $100,000 overdraft. And he got the note that your overdraft's been approved, and he accessed the account the next day, and he had a $10 million overdraft. What happened? Some of you would have seen bank keyboards. They've got a 00 key. Okay? The person typing in typed 100,000. Either the decimal point was defective, or they didn't press it, 000, $10 million was created. Now, of course, he took one look at $10 million, grabbed his Chinese passport and headed back to China, having withdrawn $7 million. They finally got him back. He's now serving a jail sentence. Should actually be working in cyber security. But that's a classic illustration where one less keystroke, effectively, created 100 times as much money. Now, there's no other industry where you can create 100 times as much by doing about 10% less. Okay? So there's something very strange about money creation, which ordinary people, non-economists, get it. It's economists who have a hard time understanding this one. So in that sense, when you look at a genuine lending, where the lending goes astray, non-repayments akin to writing off as unsold stock of a good you produce too much of anyway, which happens all the time in normal industries. And we should see this as a normal part of capitalism, which loss provisions are for a bank. But we need also now to look at it at the systemic level, because if we let this get out of control, we have a crisis like the one we fell into in 2008. So there are two solutions. The counter-cyclical spending by the government, which is the current method we use right now, which I see as an indirect method. Now, it works. Okay? If it hadn't been for government spending, we would be in a very deep hole now. We wouldn't need to go to Greece to see unemployment at 25%. It'd be happening here. Okay? Government spending is the major factor that stopped the economy going down here and globally when the crisis hit. But it didn't stop the trend towards excessive private debt in the first place. In fact, in some ways it encouraged it to go beyond the levels it would have met without a government sector to do the rescue. Quite possibly we would have had a crisis back in 1990. And it only indirectly addresses the question of inequality. And I think we need to attack that directly. So I actually am arguing in favour of not so much regular debt jubilees as making the debt to GDP ratio, the private debt to GDP ratio, a target of government policy, and to reduce it whenever it gets out of hand, and reduce it by using the state's capacity to create money. Because just as the banks can create money in a double-entry bookkeeping way, so does the government. And a major part of the myths we currently see in the debate over government spending and what it should do, and this maniacal desire to achieve a surplus, is seeing the government as a consumer of money when it's actually a producer of money. Okay? The government produces money by running a deficit, just as banks produce money by lending out more than they get back in repayments. So it's a natural part of the government's role to be creating that deficit. Not doing it is partly why we're getting up as stuffed up as we are now. But we can use that capacity directly to create money into people's bank accounts. Now, quantitative easing, as is being done now, is putting it in the bank's bank accounts, which we can't spend. But putting it into private accounts on a per capita basis, which would be regardless of whether you are a debtor or a saver. Okay, this is the big argument against debt jubilees I've always got is, well, that means people who got into debt got rewarded, where people who saved get punished. If you give it to everybody, regardless of their status, there's no discrimination in the population, but you can require the debtors to pay their debt down, to reduce their debts, whereas the savers keep the cash. Now, that would directly reduce the inequality, because a drop in the level of debt will cause a change in distribution of income in favour of workers who are the low-income ones in our society, and it will also directly reduce the private debt. So that's the main reason I argue for a debt jubilee rather than just government spending. Now, to show you the mechanism behind why a boom is caused by excessive debt and why a slowdown in the rate of growth of debt causes a crisis for everyone, put a little spreadsheet in this system. And I want to illustrate what happened in China. So I just hope this works. Let's see. I haven't embedded Excel inside my presentations before, but it should work. Watching the spinning wheel. Okay, Excel, where are you? Good. Here we go. Okay, so what I'm showing here is why China's had a crisis. And what I'm doing, I know the numbers are rather small to see, but look at the blue line. I'll explain each of the pieces. The orange line is GDP per year. And I'm just taking a GDP that starts at $1 trillion, whatever, and a debt level that also starts at $1 trillion. So there's the GDP. The blue line is the level of private debt, and what I've got is I've got the GDP growing at 10% per annum, which is roughly the rate of growth of China's nominal GDP, according to their statistician, who's under orders to report numbers like that. And I've got debt growing at 22% per annum. Now, the reason being that if I have the debt ratio growing at 22% per annum, then starting in 2008 at a debt ratio of 100% of GDP, by 2015 I get a ratio of 186%, which is roughly the actual trajectory that China has been on. What that means is total expenditure and income in this society are the sum of GDP plus the change in debt, and that's what this grey line is about. And what I've got happening is for the first 5 years, the change in debt is 22% of GDP each year, and what that means is the change of total demand, even though GDP is growing at 10% per annum, total demand is growing at 11% per annum. Then in the final year I have the rate of growth of debt slowing down from 22% to 10%, which is the same rate of growth of GDP. What does it do? Well, it means that change in debt goes from change in total demand goes from 268 million to minus 87 million, or billion. Okay? It turns around that rapidly. So a slowdown in the rate of growth of debt is enough to reduce demand from one year to the next. And that's why a crisis occurs. If I, for example, have the final year of rate of growth of debt being zero, so debt just doesn't grow, watch what happens to the grey line and the blue line. So a simple slowdown of the rate of growth of debt is enough to cause an economic downturn. And again, if I change the factor of the initial debt ratio, let's say we start a debt ratio of just 20% of GDP, much smaller. Notice the blue line is still rising after the slowdown. Even when I had the debt slow down to zero, if I have the rate of growth of debt slowing from 22% to the same rate of growth as the GDP itself, you barely notice it. In other words, these crises don't matter at low levels of private debt to GDP. They only become serious at high levels, and a colleague of mine who's a philanthropist and billionaire has looked at empirical data and said that looking at all the crises that have occurred in capitalism in the last 1.5 centuries, they've all occurred when the private debt ratio has been 1.5 times GDP and when that ratio has grown by 20% or more over a 5-year period. Now, most of the world is already in that situation, and that's why we have to do something about the level of private debt. Whether you agree with my debt jubilee or not, we have to reduce private debt because we've reached what I might call peak debt. Now, I've said there's peak debt everywhere except China. I first gave this presentation 2 months ago, modified a bit for today. That's why I've left a strike through there, because when I wrote it I said, will be the next bubble to burst. Well, it's since burst. Okay. And now let's look at the rate of growth of private debt in China versus the rate of growth in America and Japan. And that's why I said the Chinese always do things much faster than everybody else. It took the Chinese 6 years to increase their private debt by as much as Japan and America did in 17. And when you look at the rate of change of debt, it's plummeted for all countries post the crisis except China. And its rate of growth of debt was as high as 35% of GDP in 1 year early on. This is all government policy. They basically told the banks to lend because that would overcome the impact of the downturn in their export market. So when that falls back to the same level we see in the rest of the world, aggregate demand in the rest of the world will fall, the whole world, because a large part of the demand comes from growing credit. China is the only place with large expanding credit right now. When that stops expanding, demand in the global economy will also fall. So it's not just something which means a rebalancing, it's a decline overall in the rate of growth of aggregate demand. So the real cause of the decline in growth rates we've seen since the crisis has got nothing to do with the secular stagnation arguments that people like Summers make, except for the fact that declining population growth will be a factor in the countries where that's happening. But it's because you can no longer get sustained acceleration or even growth in private debt. And therefore you're going to get asset markets being as correlated as they are now and as volatile as they are now, with QE the only thing that keeps them up. And unfortunately, super cities like the one we live in becoming unaffordable because of that impact as well. And I've said a Chinese crash is inevitable. I wrote this one, as I said, 2 months before the crisis. But we're now into the danger zones. The China's now hit those danger zones well and truly, and it will not avoid a crisis. In fact, even if they were 3 times as smart as the Western managers, and I do regard the Chinese as more intelligent than most Western managers I've met, they've got themselves into crisis 3 or even 5 times or 7 times as fast if you look at various indicators. So they're in the danger zone. They've got debt much more than 1.5 times GDP. It's 1.8 if you trust the figures they give to the Bank of International Settlements. Of course the debt ratio is going to be higher than that. And it's, rather than growing by, Richard's figure was 18% of GDP, they rose by 70% of GDP over the last 5 years. So it's an enormous shock. They simply can't sidestep it. They're going to have to cope with being on the downside of the capitalist road rather than the upside. So we got into this crisis partly also out of bad economic theory. And I've spent my whole, well, not just my academic career, which goes back to 1987, but I was a student activist at Sydney University in 1972, fighting against mainstream economics back then. So I feel a very strong empathic relationship with the students who are now fighting for a change in economics. I've been doing it for over 40 years. So we need a realistic approach to economics. It's not ideological. I think you can't help but having a set of values about how you think society should function. But the ideology that's loaded in economics, patient and impatient, perfect this, imperfect that, etc., and the Austrian views about it as well, and the Marxists at the other extreme, that belongs in political science. We actually need a serious analysis of how capitalism functions if we're not going to let it destroy it. Now, most universities only teach the mainstream. There are a few universities, and thankfully London's got more of them than anywhere else, that teach non-mainstream. But the response of the mainstream has been to try to go back and re-emphasise what they think is the true faith. And that's come out of what's called a core curriculum, which you might find some of your children are going off to universities using core curriculum these days. It's just the same mainstream stuff repackaged. It's got the theme for core is teaching economics as if the last 30 years has happened. What they mean is teaching economics as if the last 30 years of neoclassical economic research has happened. They're just updating them on neoclassical theory. There's no change to the actual substance. What we need is to support universities that actually take a pluralist approach, which the student rebels are calling for now, people like the Manchester Post-Crash Society, Rethinking Economics and so on. And there are some universities that are doing that. Of course, mine is one, Kingston. And so is Greenwich. So please, to help out what I'm doing, support those universities and those students. Thank you.